Working capital operating cycle. Working capital operating cycle. Also known as the cash conversion cycle. The cash conversion cycle. Now, the working capital operating cycle, which is also known as the cash conversion cycle, is a financial metric. It's a financial metric. It is, first of all, a financial metric that measures the length of time it takes to convert investments in inventory and other working capital into cash. It is a measure. It is a measure of the length of time. It measures the length of time it takes for a business to convert its inventory and other working capital into cash. Put it differently, in simpler terms, is the time it takes for a company to purchase inventory, then sell the inventory, then collect money from customers. It is a financial metric that measures the time it takes to convert inventory and other working capital to cash. Just to demonstrate, I just said it involves the time it takes, first of all, to purchase inventory, because imagine you are a trader who buys goods, finished goods and resells, or you are buying raw materials, then you convert the raw materials to finished goods, then you sell. Because when you are selling, you could be selling your own products that you've manufactured, or products that are manufactured by other parties. Maybe you are buying from wholesalers, then you sell. So the working capital operating cycle, it is that time it takes, first of all, to purchase inventory. Then this inventory is then sold to the customers. Sell to customers, because you may sell to customers on credit. You sell, you are not given cash. It is that time that elapses between when you sell and when the customers pay. It may be 30 days, maybe 2 months, maybe 90 days. It depends on the time that you are giving your customers to pay. So it takes time to purchase inventory. Then after inventory is purchased, it is sold to customers. These customers, they are called debtors or to trade receivables. Okay? Receivables. They will take time to pay. Then it also takes time to collect money from customers. That's the cycle. Measure the time it takes to convert inventory. So you are buying inventory here first. And it could be finished products or raw materials. Are you following, candidates? Purchasing inventories includes raw materials or finished goods. Then the goods, after you've purchased the goods, then you sell to customers. That means the goods are converted into accounts receivables. Sell to customers. And that generates accounts receivables. So you have debtors, customers who owe you money. It may take time for you to raise money from them, to collect money. Okay? This means collecting money from the customers. It may take time. So that is the working capital operating cycle. You understand? So the components, let me break it down further. And please purpose in your mind to get the understanding now. Don't postpone. You just write notes, then you'll understand later. That is one thing that most students do, but I invite you not to do that. Purpose to get understanding now. Assume that you will not have the time to read what you are writing. That is if you are writing. Because I know most students come to these classes to take notes. So you compile notes. When it's about 2 weeks or 1 week exam, then you start reading. You can avoid that. You can just get the understanding now once and for all of working capital operating cycle. It is also known as the cash conversion cycle, and it's just the time it takes to convert inventories into cash. So the components, because we are saying it is the time, it is a metric, it is the time it takes, the time. Underline the word time. Just time. If you have to ask to calculate the working capital operating cycle and given information, when you ask just the time, it could be number of days. Okay? So the components of a working capital operating cycle, the first component is called inventory period. Let's break it down further. Inventory period. Inventory period. This is the average number of days it takes to sell inventory. The average number of days it takes to sell inventory. The average number of days it takes to sell inventory. The number of days it takes to sell inventory is the first component, what we are calling inventory period. Number 2, we have receivables period. Receivables period. This is the average number of days it takes to collect payments from customers. The average number of days it takes to collect payments from customers. The average number of days it takes to collect payments from customers. That's what we are referring to as the receivables period. The average number of days it takes to collect payments from customers. And therefore, candidates, working capital operating cycle. The working capital operating cycle, the working capital operating cycle will then be equal to inventory period plus receivables period. Inventory period plus receivables period. Receivables, these are debtors. Okay, so this period, the number of days, out of this number of days, that gives you the cash conversion cycle. That's the formula. So to compute the working capital operating cycle, we need just the inventory period and the receivables period. Is it clear? Is it clear, or I've used vocabulary that is not self-explanatory? Any vocabulary here? Cycle. It's called cycle because after you've collected this money from the customers, again you buy the inventory, and the cycle goes on and on. And as we'll be seeing later, if this cycle is short, then the company, we say, is more efficient and is doing good business. If the period that the company takes to convert inventories into cash, the shorter the period, the better. Because if you buy goods and sell and you have cash, you buy again in a week and you sell, you compare to a company that buys and takes longer. The one that has a shorter working capital cycle is better.